Hello friends, this is Raj Sastry from Raj Option Trading. Today is July 2nd, 2021. I want to talk about Dividend Aristocrats. These are really the companies paying more and more dividends, and these are also S&P 500 companies. So with that, let's look at few of these companies. I got two images here. First one is Nucor. Nucor is a great American company. They're into steel, and it's a great company and does very well. And we got Albemarle here, another company. They're into basic materials, and this is also a great company. And as you can see here from a definition perspective, anytime you see a payout ratio less than zero, those are the loss-making companies. We got to be careful. And payout ratio between 0 and 35%, these are really good. They can sustain the dividend. So these are really healthy companies. Then 35 to 55, these are also very healthy companies. 55 to 75% payout ratio is high. We got to be a little bit watching out these companies. 75 to 95%, very high. 95% to 150, unsustainable. You got to be careful. They're paying very high dividend, but they really cannot sustain this type of dividend. And if a company pays more than 150%, this is very unsustainable. So this is the general definition. Obviously, there are loopholes in these definitions as usual. We got to look at case by case and take it from there. So with that, let's jump in and look at few companies and see if these are worth investing. So as you can see here, the way this chart is organized is I got company here, ticker symbol, company, the stock price, market capitalization, sales and sales growth. These are very important. We got to look at sales and also sales growth. And a quarterly sales, quarter over quarter sales growth tells you recently how is the company doing. And also we can look at 1 year and 5 year to get a good idea. Then we got margin, very important. A company with a nice margin can really do very well. They can keep some of their money for themselves, especially the net margin is very important. And then you got dividend yield. So this is where a lot of folks, they want a dividend income. They want income on a regular basis. These companies will really give the income on a regular basis. That's one of the advantage of these dividend paying companies. You buy them and you can dividend reinvest, and it will keep growing. And if you're retired or if you want income, you can also take the money out from these dividends. Typically the dividends are taxed at a lower tax bracket, so that's why it's very useful to get these dividends and generate consistent income. Then we got payout ratio. As you talked about, anytime payout ratio is above 100, as example, we got PBCT here, 135. You got GPC 860. This is very unsustainable, as you can see here. And we got Leggett here, a little bit higher. So we got to be careful when the payout ratio is a little higher. But payout ratio like Nucor, very much sustainable. It's very healthy. And same is the story with Target as an example, and CINF, same story. So anytime it's above 100, you got to be very, very careful. If it is below 50, you are pretty much covered. You're good. And we got to look at debt to equity ratio. Many of these companies take a lot of money as a financial leverage or a debt. So as an example, Target may be okay, just one here, but Caterpillar high. And as you look through here, Lowe has got a lot of debt on their balance sheet. These companies do well in the lower interest environment, but as the interest rates go up, these companies will start feeling the pinch because they have to pay interest on this debt. Then we got ROE, tells you profitability of the company. As an example here, most of these companies are profitable. I like to see good double-digit ROE. In most cases, we have double digit. In some cases, we got negative ROE. For example, WWR, negative ROE, and sales is zero. It's not profitable yet. And we got a couple more single digit ROE like PBCT here, and negative ROE in case of Exxon Mobil. So those are some companies you got to really watch out a little bit and be careful. And then we got RSI, Relative Strength Index, will tell you, is it a good time to buy the stock? So if your RSI is above 55, you got to be watching out. Don't buy at that time. Wait for a good entry position. As an example here, Target, right now RSI is 80. It's good for you to wait for a pullback. It's above its 52-week high. So I would wait for a little pullback. And as you scan through this here, there is one more here. TROW price 70 is the RSI, and it's above 52-week average, 52-week high by 2%. I would wait on this one too. And same story with the as you scan through this, you'll see probably one or two more. Last one here, Cintas, same story. It's at 52-week high right now. It's good to wait a little bit before you invest in these type of companies which have got high RSI. So then we got institutional ownership that tells you the big institutions are owning the company and supporting the stock. As an example here, PNR has got a high institutional ownership, and so did Nucor, Albemarle, same story. Then we got performance. We got to look at performance carefully. So make sure company is doing well. And if there is a temporary weakness, probably in a 1 week, 2 week, 1 month, you could buy some and hold it for a while. And PE ratio tells you, how expensive or cheap, with respect to price to sales ratio. It's a valuation indicator. Things like Albemarle as example, a little bit pricey as you can see here. Basically this is a valuation ratio. Then as you look through here, we got 5-year. Some of these companies have been doing nicely. They are not just one trick pony doing well for 1 year, but as you can see here, many of these companies have done nicely over 5-year time frame, which is good to see. And then we also have, how much it's off from 52-week high. Generally, it's not a good idea to buy when the stock is close to 52-week high or above 52-week high. These are typically cyclical companies. They will always come back. Many times, as you know very well, in the Wall Street, sometimes growth stocks will do very, very nicely. And that's when these value stocks or cyclical stocks will really do a little bit badly. And sometimes, the chairs will reverse. So, I would look at this chart and look at, areas where look through here and see how much a stock is off from 52-week high. For example, Nucor. Nucor is off 14% from 52-week high. It's off 13% in one month, and it's off 1% in 1 week. So that tells you, what, this stock is a great American company, and right now they got some temporary weakness. It may be okay to buy a little bit, accumulate slowly, so that way you got a good entry position. And RSI also tells it's 47. It's good to buy. And as you scan through here, we got one more here, Caterpillar down 12%. This is also okay to buy, accumulate slowly. And as you scan through, you got a couple more here, Ben here, Franklin, same story. They're a little bit down here. And you can, Dover is another example here, or PBCT and ADM and so on and so forth. You could look at some of these companies and spot some of the temporary weakness here. Make sure they've got good gross margin, they got nice net margin, positive, then you can buy those companies slowly and take advantage of this temporary weakness. And many of these companies give very nice dividend. As you can see here, nice dividend, Nucor 1.7% yield. As you scan through here, CINF 2.2 and so on and so forth. So, this is when, be careful, look at the payout ratio. If it's unsustainable like PBCT, GPC, even LEG for that matter, use some judgment, just look at the situation here and see if it makes sense to buy at this time or you want to wait for a pullback. So this is page 1. Let's look at second page here. We got more dividend aristocrats here. And I also highlighted companies with nice gross margin and net margin, as you can see here. And we got more companies here. All are 1-year performance positive, as you can see here. Nice dividend yield, as you can see here. And also payout ratio. In some cases like VFC, FRT, and even Medtronic is okay, it's borderline, but anytime it's more than 100, you got to watch out a little bit carefully. It's a little bit red flag, go situation by situation in these cases. And we got a couple more here. Coca-Cola 98%. AbbVie, interestingly, it's a 178%. It's again a good company. Right now payout ratio is too high for this company. I like this company. I will be buying this company on any pullback, but just to watch out here. As you scan through here, some of the companies are close to 52-week high. Here we got Chubb. I love Chubb. It's an insurance company, very steady Eddie type company. They're down 10% from 52-week high. It may be good to slowly accumulate Chubb at this price levels. And as we scan through here, we got Next Era Energy. One of my favorite stock. I accumulate this stock over the time. It's good to buy this company on this temporary weakness here. This company will do well. And as you scan through here, we got Walgreen. Walgreen, I think they're getting their groove back. I think company stock fell down off late, I think last week or so because of the earnings. I think they got a new management team out by this company also into this weakness. And then we got Air Product Partners, APD. Again, stock is off 12%. It's a great stock. I think it's good to buy this also on this weakness. And I think Walmart, again, they're about 9% off. It's again a good stock. Let's go forward. I think we got last page here. Same methodology here. Many of these companies are, positive from a one-year performance perspective. And we got some with negative, one-year performance like ATO, Kimberly-Clark, Clorox. Let's look at few of these here, from a payout ratio perspective. PepsiCo, AMCR, they got high payout ratio. Sometimes realty income as an example, many folks love realty income. It's a great story, and they've been paying very consistently their dividend. Many people rely on this type of companies for day in and day out, their income, and income generation. It's a great company. Only call out is a little bit high payout ratio here. And I also love PepsiCo. PepsiCo is really great company. Payout ratio is a little bit high. I'm sure this company can manage it. Not a big deal for this company. But I would wait for, they're almost at their 52-week high. It's good to wait for a temporary weakness and then buy. As we scan through here, we got a couple more here. AT&T, I think this one right now it's not showing any payout ratio here, mainly because I think their net margin is negative. As you can see here, same story with ECL. So you got to be watch out when they don't have any earning. Their net margin is negative. They're still paying the dividend because they're dividend aristocrats. You got to be watching out for such companies with negative, net margin, and probably the negative earnings per share. But they're still paying the dividends. That's why they're very unsustainable at that point. You got to be watching out. And I love companies like McCormick, Kimberly-Clark, Clorox. They've done great last year with the COVID. Everybody wanted to buy these Clorox wipes as an example. Everybody wanted to cook at home. That's why McCormick had done very nicely last year. But now the comparables are really difficult because they have to compare their last year's revenue to this year's revenue. That's why it's become difficult for companies like McCormick, like Kimberly-Clark and Clorox to show nice growth at this point. But regardless, I love these companies. They're great companies. And even BDX as example, that's a great company, medical devices company. It's good to buy this company on the weakness and hold for a while. So with that, now we will jump into two companies in a little more details and see what they're doing and is it worth buying at this point. So first is the Clorox company. They are into manufacturing consumer and professional products worldwide, and these are really very health conscious hygiene type product. Clorox wipes, everybody knows Clorox wipes, and they also do laundry additives, bleach, and multiple things as you can see here. And this company, I think, they're doing nicely over the period of time. They're also into cat litter and other things, as you can see here. And from an earnings per share perspective, I think company doing very nicely over the period of time. Now this company has got a new CEO. I think they're doing nicely. Sales is also doing very nicely. I love this accelerating sales. Very nice here. Shares outstanding is pretty steady. That's what we would love to see. And from a news perspective, I think people are really wondering what to do with the Clorox at this point. As you can see here, Clorox hasn't formed a base yet. Could be bottoming. That's one thing Street.com talks about, and folks are really wondering. Do we still need Clorox wipes? Is COVID cleaning? Is it all over? Folks are wondering. And also dividend hikes. It's very attractive from a dividend perspective for Motley Fool. So in my mind, by looking at this news and what's going on in the market, Clorox is really trying to bottom at this point, form a nice base. I would slowly accumulate this company, and I think there are new variants of COVID coming. People are generally very conscious about these surfaces. They will always want to clean them. So with that, this could be a good story into the buying into temporary weakness. And as you look at the company here, $180 stock price right now, they're off 25% from 52-week high. They've done negative 16% in 1 year. And as you can see here, they're paying a nice dividend yield of 2.6%. Payout ratio is a little high, but manageable, not a big deal. And from a trading volume perspective, they got nice trading volume, 1.3 million shares traded in last 3 months, and nice cash on hand, 492. They also have a lot of debt, as you can see here. And as you can see here, they're spending money on the R&D. They got positive free cash flow. They also have a nice growth estimate. Not great, it's okay growth estimate for next year, which is positive. And they're above their 20-day moving average. They're also above their 50-day moving average, and I think they're below their 120-day average price, 200-day average price. Right now, that's why it's a little bit bearish at this point, but I think it's good to accumulate slowly. ROA, return on assets, is positive. And as you can see here, ROE also positive. That's good. Company is profitable. Earnings per share is also positive. PE ratio is very manageable. Valuation is not high. So with that, from a fundamental perspective, I like this company. This company has some temporary weakness right now. It's good to accumulate slowly and build a nice position here. So next we'll look at the technicals here. This is a 5-year weekly chart of Clorox, as you can see here. Nice looking chart here. As you can see here, if you buy Clorox, you can't go wrong. You can hold the stock. You can get the income generated through dividends. You can also reinvest your dividend for a nice chunk of money. As you can see here, temporary weakness right now. COVID 2020 stock has done great, multiple price expansions, as you can see here. Now it's kind of giving back its gains, and as you can see here, it's trying to make a base here. Last 2 days it went up, so it's trying to really slowly go up. I think at this point, most of these accumulation pattern is kind of done. We might see one or two more, but I think at this point stock is trying to stabilize and bounce off here from its 9-day moving average. As you can see here, RSI is trying to gain some momentum here. That's always good to know. And DMI, the blue line is trying to go up and red line is trying to come down. So sure, soon it will make a positive bullish crossover here. That will be good to watch. And from a volume average perspective, as you can see here, nice, it's trending up right now. More people are buying the stock than selling. That's always good. And smart money is also moving into the stock. As you can see here, check-in money flow is trending up at this point. So technically, by looking at the 5-year weekly chart, which is a longer horizon, looks like stock is has formed a base and is trying to go up right now. Next, let's look at daily chart here. As you can see here, it's a daily chart of Clorox. 1 year. And right now, same story here, trying to form a base here, trying to bounce off from the 9-day moving average. As you can see here, RSI is becoming positive and gaining some strength here. And as you can see here, at this point in the DMI perspective, it's already bullish crossover. So we got the blue line crossing over the red line. That's a good sign. It's trying to become bullish at this time. Volume average perspective, it's a little bit low at this point, still bearish as you can see here, but check-in money flow is indicating smart money is flowing into the stock, which is a good indicator. So with that, technically I feel like, hey, stock is forming a base. This is when we come in slowly and, form a nice position here, start building our, portfolio slowly but consistently. So I would recommend accumulating Clorox stocks into this weakness and hold it for a while. Next is McCormick. McCormick, as everybody knows, it's into spices. They're into spices, seasoning, and condiments. Any grocery store you go, they always have a spice aisle where you can see McCormick products all over. So with that, from an earnings per share perspective, nice growth. I love this earnings per share growth clip here. And sales is also very nice, very steady Eddie stock. I've been watching this stock for a long time. It's a great company. Shares outstanding is very stable, nothing alarming here. And as you look at the news here, I think they beat the estimates. That's good. They raises the guidance. That's also good. And company also off late they split their stock. It's also a good story. And from a fundamental perspective, it's paying 1.5% dividend. Payout is 44.3%, which is very sustainable. No red flag at all. They got positive gross margin, positive net margin, quarter over quarter sales growth 22%, which is also great. And in 1 year they've done 1%, as you can see here, which it can do much better, I'm sure. 5 years they've done great. They're 16% off of 52-week high. I think this stock can go much higher. And from a average volume perspective, 1.3 million shares traded. That's a very good indication. Don't pay too much attention to this volume. It's the intraday volume. I took the snapshot early in the day. That's why volume is low here. But pay attention to the 3-year average volume, which is pretty healthy. Stock is very liquid. And as you scan through here, they got a lot of cash and also a lot of debt, as you can see here. And as you scan through here, they are just above their 50-day moving average, and they're just about 20-day moving average. Stock is trying to form a nice base and go up at this point, and they are above their 120-day moving average, and also they're below their 200-day moving average. So stock is trying to go up slowly, and basically go over 50 and 120-day moving average at this point. And they've done nicely in the 10 years. 10 years, 333%. Very steady ID company. Company has been there for a long time. Great company to invest into this weakness. And from a ROA, return on asset perspective, it's positive. And from a ROE, return on equity, it's also positive. So it's a profitable company with the earnings per share of 2.87. PE ratio indicates 31.4, not very pricey at all. So fundamentally, this is a great company. I would recommend buying this company into this weakness. Next, let's look at fundamental technical here. This is a 5-year weekly chart. As you can see, your stock has done great last year with all the COVID outbreak going on. Now it's searching for direction. As you can see here, tight trading range type box. Now it's trying to go up. As you can see here, last 2 weeks companies has done positive from a performance perspective. And as you scan through from an RSI perspective, RSI is really stabilizing. That's good. It's trying to go up, as you can see here. From a DMI perspective, I think they are bullish at this time. The blue line is above red line. It's mildly bullish at this point. From a volume average perspective, as you can see, a nice volume. I love this volume average. On the balance, volume is up. That's good. Check-in money flow is kind of going up at this time. That's telling you smart money is flowing into the stock. Great story. So with that, I feel like, hey, it's a good time to invest in McCormick. Great company, nice looking chart, and they've done nicely over the period of time. Now, if you look at 1 year, 1 day chart, as you can see here, they've done nicely last year. This year, stock is kind of trading sideways. Now they're trying to, make a comeback, as you can see here. Many times people are used to cooking at home. Those habits, they won't go back to the old ways so quickly. People will still buy condiments, spices, and cook at home because they might be liking cooking at home. So with that, as you can see here, their stock split a couple of months ago, 2-for-1 stock split. I think stock is a great stock. From an RSI perspective, I think it's trying to go positive at this time. That's good to know. And right now in a daily chart, it's still bearish. The red line, the DMI chart, is above blue line. The distance is not too much. It's mildly bearish at this time. On the balance, volume is pretty nice. It's steady. It's going up slowly, which is good. Check-in money flow is indicating smart money is flowing into the stock, which is also good. So by looking at this chart here, both 5-year weekly chart and 1 year 1 day chart, looks like company is really turning a corner here, trying to become bullish after forming a base. I recommend buying McCormick into this weakness and hold it for a while. So with that, thank you very much. Happy investing and trading. Please subscribe.